Firstly, to calculate the goodwill or bargain purchase on the acquisition of Big Berhad on 1 January 2018. Great Berhad acquired Big Berhad for a consideration amounted 960 million, and since Great Berhad acquired 75% of ordinary shares in Big Berhad, the non-controlling interest will be 25%. To calculate AVNA at the date of acquisition, ordinary share capital of Big Berhad 1,050 million plus retained profit 100 million plus asset revaluation reserve 108 million equal to 1,258 million. Consideration transferred plus NCI 25% times AVNA 1,258 million equal to 1,274.5 million minus AVNA at the DOA equal to goodwill 16.50 million less impairment 1.65 million. We will get the net goodwill of 14.85 million. Secondly, to calculate the goodwill or bargain purchase of Excel Berhad for the first acquisition, Great acquired 60% of ordinary share capital of Excel for a consideration 322.5 million. Consideration transferred plus NCI 40%, which is 169.8 million equal to 519.3 million. Then we need to minus AVNA at the DOA 462 million, and then we will get the net goodwill of acquisition of Excel of 27.3 million. Lastly, to calculate the goodwill or bargain purchase on the acquisition of Good Berhad. Good Berhad was acquired by one of the subsidiary of Great Berhad, which is Big Berhad. Therefore, the consideration transferred will be calculated by multiplying 75%, which is the amount of acquisition of Great Berhad to Big Berhad, multiply it with the consideration amount, which is 180 million. The indirect CT will be equal to 135 million. The NCI will be 75% times 80% equal to 60%. 100% minus 60%, we will get the indirect NCI 40%. 205.12 million minus AVNA at the DOA equal to a net goodwill of 29.82
on gain or
million.
losses on second acquisition of shares in Excel Berhad. First, to get gain or loss of the acquisition, we need to know the consideration transferred. So the consideration transferred for the second acquisition is 67.2 million ringgit. Then we need to minus the fair value of net asset at the date of acquisition. Fair value of net asset on 1st January 2021 we get by adding the amount of ordinary shares at the acquisition date, retained profit brought forward, asset revaluation reserve brought forward, and asset revaluation of land. Then we will get 494.4 million ringgit. Before the fair value of net asset be deducted with consideration transferred, we need to apportion the amount of 20% since it is the amount of Great Berhad acquired Excel Berhad. Therefore, we will get 98.88 million ringgit of fair value at net asset at the date of acquisition. Finally, we can compare the consideration transferred amount with the fair value net asset at the date of acquisition amount, and we will get gain on second acquisition, since the amount of paid to acquire Excel is less than the fair value at net asset of Excel. Therefore, we get gain at 31.68 million ringgit.
Hi, my name is Anik Haikal. I will explain on how to prepare the consolidated statement of profit or loss and other comprehensive income. So for the first step is to list and add all the values of the parent and each of the subsidiaries from the statement of profit or loss to be included in the consolidated statement of profit or loss and other comprehensive income. Next, after list all the item and adding the values, we have to make adjustment according to the additional information given. So for the revenue and cost of sale, we have to make an adjustment by eliminating the intercompany sales and purchases of 60 and 30 million. As for the amount of 5 million and 2.5 million, we have to add back because it is an unrealized profit on the unsold inventories. Next, the profit from the sale of asset 12 million and 4.5 million between the companies need to be eliminated from the gain on disposal of PPE. Moving on to the investment income, there is a deduction of 11.7, 12 and 4.8 million due to the dividend received from the subsidiary. There is also a deduction of 3.6 million in the investment income and in expenses because of interest on the debenture paid by the subsidiaries to the parent. The amount of 2.17 million share of profit need to be added due to the investment made in Small Berhad. As you can see in this slide, the amount of 2.17 is calculated by deducting unrealized profit from the retained profit of 6 months and then times with 25% interest in Small Berhad. After we get the share of profit, we need to impair it with the amount 0.2 that we get from the question, and then we will get the carrying amount of associate. This amount need to be transferred to statement of financial position. Besides that, we have to write off the impairment of goodwill and associate. After adjusting all the additional information given, we will get the net profit for the year of 152.12 million. To get the total comprehensive income, we have to add the revaluation surplus of land during the year amounted to 0.7 million. Therefore, we will get the total amount of OCI amounted to 176.82 million. As for the profit attributable to NCI, we need to calculate each of the subsidiary profit attributable to NCI during the year in working one. As you can see in this slide, this is the calculation to get profit attributable to NCI from each subsidiaries. After getting the NCI amount, we need to deduct NCI from profit after tax to get the equity holder profit of 108.35 million.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Nakib, and now we are at working 2 to find the initial balance for the statement of changes in equity for Group Great Berhad. So we are looking at the prior years during the acquisition of Big Berhad and Excel Berhad. So what we do here is we take the pre-retained profit from their statement of changes in equity minus the retained profit at the date of acquisition to get the post-retained profit and apportion accordingly to the non-controlling interest percentage. Then we, in the NCI column, we add the NCI as the per goodwill. So in investment Big Berhad, there is a preference share of 240 million as the preference share is wholly owned by the NCI. Lastly, we add the parent initial balance of retained profit in the group retained profit column, and we will get the initial balance for the group retained profit and the NCI. Okay, now we are at consolidated statement of changes in equity of Great Berhad for the year ended 31st December 2021. Okay, for the balance brought forward has been explained in working 2. Now we look at the additional under the ordinary share capital. This is where when Great Berhad issue ordinary share capital to obtain Excel Berhad in their second acquisition. Next, we look at the subsequent acquisition in Excel, which is 98.88 million under the NCI column. This is a decrease in the NCI because they acquired more of the Excel Berhad. Then we look at the acquisition of Good Berhad under the NCI column. 45 million will be the indirect consideration transferred back by the NCI, while the 70.12 million wills the NCI as per goodwill. Then we will look at the surplus on revaluation. 24 we take it from the statement of changes equity of Great Berhad, and 0.42 and 0.28 is actually 700 revaluation surplus from the land of Good Berhad, which we apportion according to the NCI percentage. For the profit for the year, we take it from the consolidated statement of profit or loss that is explained by Muhammad Ani Haikal. Preference share dividend of 14.4 million under the NCI column is what the NCI received from holding preference share within the group. And for ordinary share dividend of 3.93 and 1.2 million is what we apportion according to the NCI percentage. Lastly, after totaling all of the column, we will get the balance of carrying forward to be included in the consolidated statement of financial position for Great Berhad Group.
Hi, my name is Amir Kamal and I will explain on how to prepare consolidated statement of financial position. Please refer to the slide. So the first step, we need to add the values from each subsidiary statement of financial position to be included in the consolidated financial position. This step is necessary except for equity section because we have already obtained the values from previous working on SOCI. Next, after list all the items and add up the value, we need to make an adjustment according to the additional information. Here are some of the adjustment. The PPE we will add by 3, 1.C and 0.7 million due to the surplus on revaluation of land. The deduction of 16.5 million is due to disposal on non-current asset within the group. Meanwhile, the addition of 0.9 and 3 million is due to realized profit on disposal of non-current asset within the group. Next, we will sum the value of goodwills from previous calculation to get the total carrying amount of goodwill. Also notice you that the carrying amount of investment in sub and associate amounted to 46.97 million is derived using equity method. The cash in transit of 16.2 million is due to the difference between payment and recipient timescale, as mentioned in additional information 1, when Great Berhad has only received the amount on the next accounting period. In account receivable, we deduct it by 90 million due to the intergroup transaction of selling goods between Great Berhad, Big Berhad and XL Berhad. Besides that, we also have adjusted the inventory by deducting 7.5 million. This is due to unrealized profit of the sale transaction within the group. In non-current liability, we deduct 45 million from the debentures. The reason is because Great Berhad owned 45 million debentures in XL Berhad. Therefore, we need to eliminate intra-group transaction. Lastly, we also deduct 73.8 million from payables to offset the sales transaction within group. Also, we derive the information from additional information 1. So, the balancing figure we got is
moving on to question number 2. Question number 2 states that Nel Berhad and Shinji Berhad acquired 50% shares respectively in FNE Berhad on 1st January 2022. This question required us to give our opinion on Nel Berhad, Shinji Berhad and FNE Berhad with reference to this relevant MFRS, which is MFRS 10 and MFRS 11. I will explain for MFRS 10. MFRS 10 states that every parent business is required to present consolidated financial statements that combine the financial statements of all of their subsidiaries. Okay, so how can we identify the holding? There are 4 situations to identify the holding, which are: first, investor who have largest portion of the voting rights; second, composition of the governing body of the combined entity; third, composition of the senior management of the combined entity; and lastly is the terms of exchange of equity interest. To relate with the case of Nel Berhad and Shinji Berhad acquired FNE Berhad, both acquired 50% shares in FNE. Both investors have the same equal amount of voting right. Therefore, portion of voting right is not a domain factor to determine the holding. Stated in the question, senior management appointed by Nel Berhad has the right key to make decision, but senior management appointed by Shinji Berhad right to make decision is silent in this question. We can assume that composition of senior management appointed by Nel Berhad is higher than senior management appointed by Shinji Berhad. In addition, Nel Berhad has supervisory roles in monitoring the project and getting approval from board of directors. This shown clearly on who's the one should govern the combined entity. Therefore, in accordance to MFRS 10, Nel Berhad should prepare the consolidated financial statements, since Nel Berhad has exercised its power towards FNE Berhad and responsible to the relevant activities that can affect the company's return.
According to MFRS 11, a joint arrangement is an arrangement of which 2 or more parties have joint control. The parties are bound by a contractual arrangement which can be evidenced in form of contract, and it will give 2 or more of the parties joint control of the arrangement. Okay, in this scenario, Nel Berhad and Shinji Berhad acquired 50% shares respectively in FNE Berhad. However, there is no contractual arrangement between them to consult Shinji Berhad or make a collective decision in the decision making of F&E Berhad. Therefore, without the substance of contractual arrangement, both companies are not to be treated under MFRS 11 joint arrangement. However, MFRS 3 states that business combination occurs when an acquirer obtains control of one or more businesses. Alright, so some of the consideration in determining control: when the investor can appoint the investee key management personnel who can direct the investee relevant activities. Next, the investor can direct the investee to enter into significant transaction and also can dominate the process to elect the investee governing body. Next, the investee key management personnel and the majority of the members of the investee governing body are related parties of the investor. Alright, so in this scenario, NEL Berhad can appoint one F&E Berhad senior management team member who has the right to make key decisions on an important project and how the project is financed. NEL Berhad also has supervisory roles in monitoring the project undertaken and getting related approval from the board of directors. NEL Berhad can use its power over F&E Berhad to affect the amount of the investor returns. As for those reasons, we believe that F&E Berhad is the subsidiary of NEL Berhad, and there is no joint arrangement between NEL Berhad and Sinji Berhad due to no contractual arrangement between them.
Next is question 3, where it discusses about Hendrik Berhad, a parent company that wants to acquire Kendall Berhad in order to gain access to new markets and raw material at a lower cost. So Hendrik Berhad acquired Kendall Berhad on 1 January 2018. So in 2020, due to a poor performance of Kendall Berhad, Hendrik decided that they want to decrease their shareholdings in Kendall Berhad. So on 30th June 2021, Hendrik disposed 85% of his equity shareholding in Kendall Berhad. So the accounting treatment of Kendall Berhad acquisition on 1 January 2018 is that Hendrik Berhad consideration transfer of 27 million plus the NCI of 5.2 million will be put off against the fair value of net asset of Kendall Berhad at the date of acquisition. As a result, a goodwill of 6.2 million will be recognized. Kendall Berhad will become the subsidiary of Hendrik Berhad, and its liability and asset will be consolidated in the Hendrik Berhad Group consolidated financial statement. Both the NCI and the revaluation gain on land will be credited in the group consolidated statement of changes of equity under NCI and asset revaluation reserve respectively.
I will continue with the calculation of gain or loss on the disposal of the share for Hendrik in Kendall. Hendrik Berhad disposed 85% of its equity shareholding in Kendall. Initially, Hendrik acquired 80% of share capital in Kendall, which is amounted 12 million. After the disposal, 85% times 80 times 50 million, the amount of disposal is 10.2 million. For a proceed 26 million. The disposal was made on 30 June 2021. So to calculate, proceed from disposal 26 million plus the fair value of remaining assets on the date of disposal are 10 million given in the question equal to 36 million. The FVNA at the DOD is 35 million also given in the question minus 5 million loss for the year calculated from 8 million apportioned 6/12 and equal to 31 million. 31 million times percentage of the share initially 80% equal to 24.8 million. 36 million minus 24.8 million will be equal to 11.2 million minus the goodwill remaining 5.4 million equal to gain on disposal of shares of 5.8 million. As for the effect on the disposal of share in Kendall, when the parent company, Hendrik Berhad, disposed its investment in the subsidiary, Kendall Berhad, the shareholding will be decreased by 6.2 million. In this case, Hendrik disposed 85% of its equity shareholding in Kendall. This means the interest of Hendrik in Kendall will be decreased to 15%. It will be consolidated in group statement of profit or loss until the date of disposal, 30 June 2021. The non-controlling interest will increase from 20% to 85%, and since the interest in Kendall is left 50%, the relationship will be changed from a subsidiary to a simple investment. Any remaining goodwill, 5.4 4 million will be written off against gain or loss on disposal, and any gain or loss 5.8 million is taken to CSOPL. For subsequent period, dividend paid by the investee will be recognized in the group statement of financial position, and the investment will be disclosed at the carrying amount as an asset under MFRS 139.
Okay, so we have arrived at the last question, which is question 4. In this question, it required us to explain the relationship between Plankton and Sandy Berhad after the purchase of shares made by Plankton Berhad. Okay, to answer this question, we have to look at the MFRS 128. According to MFRS 128, investment in associate and joint ventures, it states that an associate is an entity over which the investor has significant influence. It means that the investor has the power to participate in the financial and operating policy decision of the investee, but not control over those policy. So, in the case of Plankton Berhad and Sandy Berhad, there is an existence of investor and associate relationship between those companies because Plankton Berhad has significant influence. There are two pieces of evidence to prove this matter. Firstly, Plankton Berhad directly hold 25% control of interest in Sandy Berhad, which make Sandy Berhad an associate. Secondly, Plankton Berhad had the right to participate in the policy-making process and interchange of managerial personnel of Sandy Berhad. So that's all from us. Thank you.